Tesla just dropped its Q1 delivery numbers, and let's just say this wasn't the headline Wall Street was hoping for. So, did Tesla actually miss expectations, or is there something bigger going on here? Let's break it down. Tesla reported roughly, insert latest figure if you have it, vehicles delivered in Q1. On the surface, that might sound like a solid number, but here's the problem. Expectations were higher. Analysts had been projecting stronger growth, especially after Tesla's aggressive price cuts and global expansion strategy. And this is where things get interesting, because this isn't just about a miss, it's about what this tells us about demand, competition, and Tesla's next move. First, let's talk about the obvious. Deliveries came in lower than expected. That immediately triggered concerns about slowing demand. If price cuts didn't boost deliveries as much as anticipated, then what does that say about Tesla's pricing power? But here's the twist most people are missing. Tesla doesn't operate like a traditional car company. They've been intentionally playing the long game, sacrificing short-term margins to dominate market share. So while some analysts are calling this a weak quarter, others see it as a strategic move. Think about it. Tesla slashed prices across multiple markets over the past year. That compresses margins, sure, but it also puts massive pressure on competitors who can't afford to do the same. Legacy automakers are already struggling with EV profitability. Tesla, they're still making money, just less of it per car, and that gives them a huge advantage. Now let's zoom out. Q1 is historically Tesla's weakest quarter. Seasonality plays a big role. Lower consumer spending after the holidays, factory transitions, and logistical slowdowns all factor in. So comparing Q1 directly to Q4 is misleading, but even accounting for seasonality, the growth rate is slowing, and that's the real headline. Tesla is no longer in hyper-growth mode, at least not in the way it used to be. The company is transitioning from explosive expansion to something more mature, and that shift comes with challenges. Competition is heating up globally. Chinese EV makers like BYD are scaling fast. In Europe, local manufacturers are pushing harder into EVs, and in the US, incentives and policies are reshaping the landscape. Tesla is still the leader, but the gap is narrowing. Now here's where things get even more interesting. Production numbers. Tesla actually produced more vehicles than it delivered this quarter. That means inventory is building up, and that's something investors always watch closely. Rising inventory can signal weakening demand, or it can mean Tesla is preparing for a surge. So which one is it? Well, there are a few possibilities. 1. Logistics. Tesla often has cars in transit at the end of a quarter, especially with global shipping. 2. Demand timing. Some buyers may be waiting for new incentives, refreshed models, or even the rumored next-gen vehicle platform. And 3. Tesla could be ramping production ahead of future demand. But there's another factor people aren't talking about enough: the Model 3 refresh. Tesla recently updated the Model 3 in several markets, and transitions like this often slow deliveries temporarily. Customers hold off to get the new version, and production lines need time to adjust. So part of this miss could simply be timing. Now let's talk about the stock reaction. Whenever Tesla misses expectations, even slightly, the market reacts, sometimes aggressively. That's because Tesla isn't valued like a normal car company. It's priced as a high-growth tech company, and high expectations mean even small disappointments can trigger big moves. But long-term investors? They're looking at something else entirely. They're watching Tesla's roadmap: full self-driving, AI, robotics, energy storage, the next-gen platform. These are the things that could define Tesla's future, not just quarterly deliveries. And Elon Musk has been very clear about this. He said multiple times that Tesla's real value lies in autonomy and AI. If that vision plays out, vehicle deliveries become just one piece of a much bigger puzzle. So when you look at these Q1 numbers, the real question isn't just did Tesla miss, it's this: does this change the long-term story? And right now, the answer depends on what you believe. If you think Tesla is just a car company, then slowing growth is a problem. But if you see Tesla as a technology platform, one that's still expanding into new industries, then short-term fluctuations might not matter as much. Either way, one thing is clear: Tesla is entering a new phase. The easy growth is behind them, the competition is stronger, and the expectations are higher than ever. So every quarter from here on out, it's going to be under a microscope, and that makes moments like this even more important.